Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and other important issues surrounding being self-employed, working for yourself, running a small business. So today we're going to talk a little bit more about tax relief for pension contributions, specifically for those who are high rate taxpayers. Before I do, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as being able to find other information that we have available on a whole host of topics, all aimed at supporting you in your self-employment. So back then to pension contributions, and specifically if you are a high rate taxpayer. So in another video we talked generally about tax relief for pension contributions and how this works. And one of the questions that's cropped up a lot is, what if I am paying my pension contributions from my limited company and I am a high rate taxpayer? So just to clarify then on this, so if you are a limited company and you are, as a director, you're paying your pension contributions directly from your company, i.e. the company, the pension contributions are a cost of the company, then this means that they will reduce the profit of the company by the amount of the pension contributions that are made. So this is how you get your tax relief. So if your profit was, for example, £20,000 and you made from the company, also, I should say the company made a contribution to your personal pension of £10,000, then that £10,000 would therefore reduce that profit. And so instead of paying corporation tax on £20,000, you would only pay corporation tax on £10,000. So effectively, that money that's going into the pension pot has not had any tax. So it would just be the actual contribution that goes into the pension, because there's no tax relief to be added back, because the tax relief's already been given by reducing the profit of the company. And then another aspect here that's can be a cause for some confusion is that money, therefore, that the company has made, that pension contribution into your personal pension as a director, the money therefore has transferred out of the company into your personal pension. So it's no longer owned, that money is no longer owned by the, it's no longer an asset of your company, it's now your personal pension pot. But as that money comes out, because it was an expense of the company, there's no personal income involved. So in that scenario I just talked about, if you had from your company had made a director's pension contribution of £10,000 into your personal pension, and let's say your total income in the year through the company, say through the PAYE scheme, was 50,000, for example, it's still going to be 50,000. That 10,000 is nothing to do with your personal income at this point. The money's moved out of the company into your personal pension without having any impact on your personal income. Of course, a different topic, when you come to draw that pension out, then it will become your personal income. But certainly at the point of that contribution being made, there's no personal. So even if you are a high rate taxpayer, that money will not be taxed at high rate tax, because that is your personal tax, and the company will only pay corporation tax, and it will save corporation tax in its entirety on the contribution that it makes. So hopefully that clarifies why there's no further adjustment, why you wouldn't then declare that on your tax return as a personal pension contribution. Because when we talk about personal pension contributions, we're talking about your own money it's already your money, it's already been, whether from whatever purpose that you've had that money, whether it's money that you've been paid from an employer, whether it's money that's been paid out as a dividend, or whether it's just simply savings that you've had. When it's your own money that you're paying directly into a pension, or in the scenario where you're a sole trader, because of course a sole trader, the business and the sole trader are one and the same. So if you're making a pension contribution from a business account and you are a sole trader, then that is not a business expense. For that would be drawings from the actual business account, and that would be a personal pension contribution that you would declare on your tax return, particularly if you're a high rate taxpayer, and that is how you would get your tax relief on the for the element of 40%. So if you were a high rate taxpayer, let's just round up and say the threshold is £50,000, and let's say, for example, you pay £5,000 of your own money into a qualifying pension in the tax year, then it would be important that you make sure that HMRC know, either by a quick phone call or on your personal self-assessment tax return, let them know that you've made that £5,000 of contributions, and then that 50,000 threshold would be increased by that 5,000. And in that example, where we've rounded the high rate threshold to 50,000, and we're saying in this example you've paid £5,000 personal pension contributions, you would then not start paying high rate tax. Instead of start paying it at 50,000, you would start paying at 55,000, and that in effect means that that £5,000 of pension contributions you've only paid tax on at 20%, and you get the tax relief directly into the pension. So it's only if it's personal, your personal money, or you're a sole trader. So it's one or the other. If it's not an expense of the business, then it's personal. If it's personal, then it's not an expense of the business, because of course in that scenario you would be getting tax relief twice, because you're either getting the tax relief because you're a limited company and you're reducing your profit for corporation tax purposes by the amount of the pension contributions, so therefore that money is going into the pension untaxed in effect, or you are having 20% tax relief applied and you are letting HMRC know how much pension contributions, and only if you go into high rate tax over the high rate tax threshold would your personal tax, because it wouldn't need to be otherwise, because you would only be paying 20% tax and you would get that relief as default. And as I mentioned previously, we're simply talking about the pension contributions from an accounting and a tax relief perspective. So there are other things, lots of important things, of course, to consider, because a pension is a very long-term investment. So it's really critical to make sure that you get absolutely the best advice. So if you are in need of any information on pensions generally, then please do ensure that the person you're asking that advice is regulated and fully qualified, and try and get some personal recommendations too, because if you pay into a pension for potentially decades and then you find out at the end that you had poor advice, of course by then it's too late to do anything about it. So it really is critical that you get good advice at the start and make sure the person's regulated and qualified to give you the advice. So it's really worth taking some time to think about what you're doing with your pension contributions, to make sure that you maximise tax relief, particularly if you're a high rate taxpayer, and that you really do set yourself up for the best pension and provision when you're ready to retire. So thank you very much for watching. I hope this has been helpful. If it has, please do take a second to like the video. And if you haven't already, please do subscribe to our YouTube channel so you can refer back to the information and find other information. And if you want to be notified when we upload new information, which will on a whole host of topics, all aimed at supporting you in your self-employment, then please do turn on the notifications. Thank you very much. Goodbye.